Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, October 1st. Fundamentals fall by the wayside when emotion drives the market. That's why the market can stay overbought or oversold for an extended period of time. This is clearly one of those emotional periods for the market. In this period, though, it is fear and not greed that has been the predominant factor influencing investment decisions. There's a fear of the economic outlook, there's a fear of the political outlook, there's a fear of the earnings outlook. Not surprisingly then, there's a fear of the stock market outlook. Those fears have bubbled to the surface in a big way of late, knocking stock prices sharply lower on the rising fear that the problems for the financial sector are now going to bleed into the real economy in a big way. That view has been validated to a large extent with the recent proposal to provide up to $700 billion to buy troubled assets from financial firms and warnings from key leaders about the grave consequences the economy will face in the absence of such a relief plan. Entering the fourth quarter, the stock market is dealing with a significant degree of uncertainty. The relief plan as of this posting has yet to be passed, and recent economic reports have revealed increasing signs of softness, particularly in the key component of consumer spending, which accounts for roughly 2/3 of GDP. Investors are understandably anxious at this point, and the prevailing fear among investors is that the market, down 22% year to date, will head even lower. It could. We don't know. Nobody does. Still, the key consideration now is the risk-reward trade-off at current levels. In 2002, the S&P was down 32% for the year at its low in July. In a span of 4 weeks, it rallied nearly 25% to an interim level of 965 before giving way to another wave of selling activity that knocked it down 20% to its October low of 768.63. Hindsight revealed the latter was the low point of that bear market. Over the next 12 months, the S&P would gain 32%. Over the next 5 years to its bull market peak, it would gain approximately 100%. To be sure, the 20% sell-off from the August 2002 peak to the October 2002 low was painful, but your return 5 years later from that August peak, including dividends, was 81%. Suffice it to say, that was a favorable long-term risk-reward opportunity. In thinking of the market today, there are two views to consider, the near-term view and the long-term view. The near-term view is quite uncertain. It will improve in our estimation upon passage of the aforementioned relief plan, as that should help get credit flowing again. Still, that is not a cure-all for the economy. The housing market won't recover overnight, consumers aren't going to start spending freely again, and global economic growth isn't going to rev up instantly to its full potential. It is an act, though, that will have a stabilizing influence on the capital markets, and that should be enough to wring out some of the excessive fear in the market that in turn could produce a respectable rally. Incidentally, the Stock Traders Almanac notes that October has served as the inflection point in 11 post-World War II bear markets. November, meanwhile, marks the beginning of what has historically been the best 6-month return period for the market. Briefing.com does not know if a bottom has been reached, although we believe the risk-reward profile for the market has tilted in long-term investors' favor with this bear market retreat. There could be another 10 to 20% slide in the market, but ultimately if there is 50% upside or more from the current level, that's an acceptable risk for investment-minded individuals who should not concern themselves with trying to time the market and should not allow themselves to be led into the echo chamber to sell in panic-like fashion. These may be unprecedented times, but so is every other major crisis that precipitated some scary-looking selling activity. In each of those instances, the stock market recovered and new wealth was created. From the panic of 1907 to the depths of the Great Depression, to World War II, to the Kennedy assassination, to the OPEC oil embargo, to the crash of 1987, to the S&L crisis of the early 90s, to the attacks of 9/11, the stock market has persisted as an inexorable wealth creation machine. Some periods are more challenging than others, and this is one of those periods. History has shown time and again, however, that it is paid to be patient and to remain invested in the stock market. We can't pick the bottom, but we can fall back unabashedly on that fact. The near-term situation is uncertain, and the presidential race adds to that uncertainty. This is not a period to be investing aggressively in individual stocks, yet the dollar-cost averaging approach into mutual funds or index funds remains a prudent one for long-term investors. I'm Pat O'Hare for Briefing.com. Thanks for listening.